and welcome to the final lecture for Business Entities Overview for Federal Tax 2, Taxation of Business Entities. In this particular lecture, we're going to discuss the last learning objective, where we are identifying fundamental differences in tax characteristics across the business entity types. So taxation of flow-through entity business income. So income generated by flow-through entities is taxed to the entity's owners, not at the entity level. The income is allocated to the flow-through entity owners, and that increases the owner's basis in their ownership interest. Consequently, the distributions to the entity's owners are treated as non-taxable return of capital to the extent of the basis in the ownership interest. Now, for C corporations, they pay entity level taxes. So shareholders additionally pay a second level, double taxation, when they sell stocks or receive dividends. And then entity income and dividend distributions do not impact your stock basis. So now we're going to turn our attention to qualified business income deductions that are potentially available to these flow-through entity owners from an adjusted gross income deduction perspective, but not as an itemized deduction. So 20% of the qualified business income that is reduced by other deductions attributable to the trade or business. For example, you can have deductions from taxpayer self-employment tax or self-employment health insurance or contributions to retirement plans. But then that business income is qualified business income unless it is a form of specified service. And that qualified business income must be earned in the U.S., and the deduction is subject to wage-based limitations and taxable income limitations. So let's look at the specific trade or business requirement. So there are phases in and of course phases out as taxable income before you can do the qualified business income deduction. As long as it exceeds, is greater than the threshold, which is always indexed for inflation, and it's based on the taxpayer's filing status. So if your taxable income before the qualified business income is equal to or less than $182,100, or $364,200 if you're married filing jointly, then that specified service requirement does not apply. The specified service requirement can phase in pro rata over a $50,000 range or $100,000 if you're married filing joint. Now let's look at the qualified business income deduction based on wage-based limitation. So if the qualified business income deduction cannot exceed the greater of 50% of the wages paid with respect to that qualified trade or business, or the sum of 25% of the wages paid with respect to the trade or business, plus your 2.5% of the unadjusted basis of all qualified property in the qualified trade or business. So it's an or here, so it's one or the other. As long as you meet one of those and it cannot exceed or be greater than that, you can have the QBI deduction. So then wage-based limitation phases in and obviously resulting in less deduction as the taxable income before that qualified business income deduction exceeds the same threshold used for the specified service requirement phase-in threshold. And as you can probably tell from all of this, it's very specific. So you want to make sure that you understand each of these and make sure you use this for your tax exams. So now let's talk about the qualified business income deduction on taxable income limitations. So your qualified business income deduction cannot exceed 20% of taxable income before the qualified business income deduction, taxed at ordinary rate. So this is the taxable income before the qualified business income deduction minus your net capital gains and qualified dividends, like income that was taxed at a preferential rate, not an ordinary rate. And then to determine the qualified business income deduction before that taxable income limit, and then you have to compare that taxable income limit to get to the final amount of the deduction. So it's always a step-by-step process with taxes for business entities. But the good thing is you don't have to remember all of this. You just have to know enough to be dangerous. So now let's talk about the flow-through income that is taxed at the individual marginal tax rate. So the top individual tax rate is 37%. And then passive investors also are potentially subject to another 3.8% of net investment income tax. So owners of entities are taxed as partnerships, and sole proprietors who are involved in the entity's business activity are also potentially subject to another 3.8 to 15.3% self-employment tax and another 0.9% of additional Medicare tax as well. And then you have the self-employment tax basis is really your net earnings from your self-employment. So these net earnings is actually what we put on Schedule C and the net Schedule C income, and we multiply it by 0.9235. And then the first $160,200 tax base is taxed at 15.3%. Anything above the $160,200 is then taxed at 2.9%. And S corporations, our shareholders, are not subject to self-employment tax or any additional Medicare tax on business income that came from an S corp. So now let's talk about the corporations and what they pay. So they pay 21% entity level tax. Then there is a second level of tax when after-tax earnings are distributed as dividends to the shareholder or when a shareholder sells stock. So as an individual shareholder, you will pay a second tax, whether it's 0, 15, or 20%, depending on the individual's taxpayer's income level. And additionally, you can also pay another 3.8% net investment income tax, again, depending on your income level. And then we have the corporate shareholder. So you have to include dividend in your income. And then the dividends that you received a deduction of 50% or 65% or 100%, depending on the extent of the ownership you have in that corporation. Institutional shareholders, they don't have to pay shareholder level taxes on dividends, just we individuals. Then we also have tax-exempt organizations, right? So these are churches or universities like our own that are exempt from paying taxes on investment income, which also includes dividend income. But in order to do that, tax-exempt organizations have to file a 990, a return of organization exempt form income tax. There could be some tax-exempt organizations can potentially be subject to tax on some type of unrelated business income to the rate of 21%. They also have to file a Form 990T, which is exempt organization business income tax return, if that gross income from these unrelated businesses is greater than $1,000. If you are a foreign shareholder, you may be eligible for reduced rates on this dividend income, and it just really depends on the tax treaty between the organization, the other country, and the U.S. So corporations can, which is lovely, defer a second level of tax by not distributing earnings. So if you're doing retained earnings for your tax avoidance rather than a business purpose, corporations, then you can accumulate those earnings taxes or potential holding company tax. So that can happen. You just don't distribute earnings. Now let's talk about owner's compensation. So if you are in an S Corp, there is no compensation. If you're in a C Corp, or an S Corp, if you're in a sole proprietorship, there is no compensation. If you're in an S or a C Corp, you do get wages or salaries. You could be subject to FICA taxes, and the wages are deductible by the entity. So the compensation to a C Corporation shareholder is deductible to the extent it is not unreasonably high. It can be recast as non-deductible dividend to the extent that it is not reasonable. So define reasonable, right? We don't know. The wages here for an S Corp or a C Corp are not eligible for the qualified business income deduction, and the business income allocated from the S Corp to the shareholder or the employee, that does not have to be paid FICA tax. The incentive is to keep the salary low to reduce that FICA tax. And then compensation for the S corporation's shareholders or employees must not be unreasonably low. Again, these distributions can recast as salary to the extent if they are unreasonably low. Define unreasonably again, right? So owners compensation for owners of entities that are taxed as partnerships, they do receive guaranteed payment as compensation, right? So you might have self-employment income. They are deductible by the entity, but they are not eligible for the qualified business income deduction. Then we have deductibility of the entity's losses overall, right? So C corporations have a net operating loss carryover that is incurred in tax years beginning after 2018. So you can carry back 2 years, you can carry forward 20 years, and you can offset 100% of the taxable income in those years. For C corporations with a net operating loss that is incurred in years beginning after 2017 and for years beginning after 2020 and before, now you can carry back your losses 5 years, you can carry over indefinitely, and for the tax years that begin before 2021, you can offset 100% of that taxable income before the net operating loss deduction. Now for tax years after 2020, you can offset 80% of your taxable income that is remaining after you're deducting your net operating losses from those tax years that began before 2018. Then for C corporations that have a net operating loss that they incurred with tax years beginning after 2019 and still remaining up until 2020, you can carry forward indefinitely. You cannot carry back, but you can offset 80% of that taxable income remaining after deducting the net operating loss carryovers from those tax years that began before that 2018 date. So net operating loss carryovers deducting in FIFO order, first in, first out. Losses are not available to offset the owner's income, so keep that in mind. Then we have losses that are generated by flow-through entities that are generally available to offset the owner's personal income now, but this is subject to certain restrictions. You have to take into consideration the basis, at risk, any passive activity, and if there is excess business losses, it's $578,000 if you're married filing joint or $289,000 for all other filing statuses. So other things to consider as we're looking at all of the entities' tax characteristics, right? So you want to consider the differences between the entities. You want to consider any owner's limitations, the owner's contributions to appreciated property that was given to the entity. As always, accounting comes into play, so we want to look at accounting periods, the overall accounting method, and the allocation of income or loss to the owners. And we want to also take into consideration the share of the flow-through entity debt that is included in the basis of the owner's equity interest, and any non-liquidating distributions of non-cash property and any liquidating entities. And several of these topics we will discuss throughout the semester. And then we want to see about converting some entities to other entity types. So if we look at C corporations, right, you may be able to make an election that it is taxed as an S corporation, but you may not qualify to make that election. So you have to look at those rules. But you may liquidate and form an entity taxed as a partnership, but the tax cost of liquidation can be significant. And then you have entities that are taxed as partnerships or sole proprietorships, and generally non-taxable to form as a corporation, but very common that we'll do this in advance of an initial public offering. And that is the end of this presentation. Thanks for watching.